All right, what's up, my future multi-millionaires? Welcome back to another California real estate study guide video. Let's get straight to it. Boom. Typically, a developer slash builder would have what type of mortgage on his development? A wraparound with a partial release clause, a blanket, an interest only with annual payments due, a conventional fully amortized. Let's try blanket, like Michael Jackson's Child. All right, question rationale. A wraparound mortgage is a second mortgage written to cover the first and second mortgages on one property. An interest-only mortgage is usually a very short-term loan with the payments going only to the interest on the loan. A blank mortgage covers more than one property, with the development and its parcels released as they are sold. A fully amortized conventional loan would cover one parcel only, with part of the payment going towards interest and part going towards principal. The balance is due at the end of the loan period. Next question, number 2. Which loan is often used by older homeowners who have owned their homes long enough to gain a great deal of equity? Rollover mortgage, reverse annuity mortgage, variable or adjustable rate mortgage, shared appreciation mortgage. It might be a reverse annuity mortgage. Yeah. Question rationale. Under a reverse annuity mortgage, the lender pays the borrower and the loan is not repaid until the borrower dies or sells the property. Question number 3. The note that calls for periodic payments on the principal, not including interest, and calls for a balloon payment at the end is called this is money ball. This is something you need to know. There's a lot of these different ones too that you can get mixed up with. So let's see. I believe this one might be a partially amortized installment note. It could be a straight note too. There we go. So you got to know these ones because these are money ball questions that will pop up on your test, and it'll help you get those easy questions that you need. So a partially amortized note calls for periodic payments of principal only. The interest is be due at the end of the term. I don't know why they put that. That was weird. That was a weird sentence. Number 4. The type of lender having the greatest percentage of assets invested in residential mortgages are life insurance companies, mutual saving banks, commercial banks, savings and loan associations. Let's try savings and loan associations. I remember that one because I read that in the book, and I think it's only that one too. So a savings and loan is the most invested. The premises of a savings and loan is to take the deposits in savings accounts and use them to make loans for depositors. Question number 5. Which loan is not guaranteed or insured by a government agency? The VA, conventional, FHA, land contract. I think it's conventional or is land contract. Let's try land contract. It was conventional. Conventional. Let's see why. FHA is insured by the federal government, while the VA loans are guaranteed by the federal government. A land contract is not a loan, but rather a method of purchasing property on an installment plan. And conventionals are just regular from the banks. Now, however, I did get mixed up because of Fannie Mae and Fannie Mac. They put out the guidelines for the loans, but they're not giving the loans. So that's why it's conventional. Number 6. A type of financing available for real estate mortgages in which the annual percentage rate will differ from year to year according to terms specified by the lender is known as fluctuating loan, fixed rate mortgage, adjustable rate mortgage, amortized loan. Let's see fluctuating. Adjustable rate mortgage. Amortization refers to the method of paying off a loan with varying amounts of principal and interest each month. Although the interest rate may stay the same, by definition, the percentage interest rate of adjustable rate mortgages varies from year to year. Fixed rate mortgages are those in which the annual percentage rate never changes. Question number 7. We're clearing these today. An investor decides to take money out of a savings account and invest it in corporate securities in order to obtain a higher yield on his investment. This movement of money is known as dedication, discrimination, debt service. Is disintermediation. Okay, the movement of money out of a savings account into a higher yield investment, such as a corporate and government instruments, is called disintermediation. Debt service is the amount of money paid in regular intervals to reduce the balance owed on a debt. Question number 8. When a trust deed debtor is in default on a loan, The loan may be reinstated if all delinquencies and fees are paid prior to how many days before a trustee sale? 10, 5. A borrower has until 5 days before a trustee sale to pay all delinquent amounts and fees. 5 days. Question number 9. What type of note calls for interest payments during the term of the loan and principal due at the end of the loan? Straight term loan, installment loan, amortization loan, balloon wraparound loan. Say balloon wraparound. Oh, straight term loan. That straight term loan is one you need to really know. Anything that say straight, you need to know. Amortization, you need to know. The balloons, you need to know. Installments, you need to know all of them. So study them hard. So question rationale. The monthly payments of an amortized loan include both principal and interest. In a straight term loan, only interest is paid each month. And a lump sum principal payment is due at the end. A wraparound loan combines two loans into one for an average interest rate. All right, question number 10. Which act prohibits discrimination in lending practices? The Rumford Act, the Holden Act, UNRRA Civil Rights Act, the Class Act. Well, it's either the Holden Act or the Rumford Act, because that's also, let's see, I think it's the Holden Act. Yep. Under the Holden Act, lenders are prohibited from redlining and charging extra fees for providing documents printed in languages other than English. And since I love you guys so much, I'll give you a bonus question. However, since I'm giving you this bonus question, you gotta like and subscribe. I see some of y'all is watching the videos, the views is going up, but y'all not liking, commenting, or subscribing. So subscribe to your boy for more dope content so I can expand my content into doing more than just study guides. I can show you guys the actual life of a real estate agent. Let's go. Question number 11. Which federal statute requires the lender to give a borrower a statement of total interest being paid over the life of the loan? The Federal Fair Housing Act, Fair Credit Reporting Act, Regulation Z, Equal Credit Opportunity Act. Shit, it's either B or D. Let's go with the Fair Credit Reporting Act. Oh, it was Regulation Z. Neither. Regulation Z is very important too. Regulation Z of the Truth in Lending Act. That's what I was looking for. I was looking for something that was in the Truth in Lending Act. So Regulation Z is in the Truth in Lending Act. Requires that a lender discloses to a borrower all costs of obtaining a loan, including the interest rate, cost of payments over the life of the loan, etc. The Equal Credit Opportunity Act requires equal credit opportunity be given to persons regarding of race, religion, sex, etc. The Fair Credit Reporting Act requires that a creditor truthfully record credit remarks on an individual credit report. All right, you guys, thank you for studying with me. Go ahead, rewatch it 3, 4, 5 times. Memorize, brainwash yourself, and you will pass. Trust me. Have a good one.